Hello everyone, thank you very much for watching. Today I would like to share with you some of the answers, tips or questions that people would like to know about property investing. The topic I've choose to talk about is how to buy houses without money. So if you're watching, I would assuming that you either maybe not having enough money saved up to buy the property, or you want to scale your business much faster without using your own money. Whichever way is fine, because typically speaking, you don't really need any money for buying property if you know how to do it. So now here's a few different ways, not just one way, a few different ways, depending on the circumstances. Buying houses without using money implies that you will be using other people's money. Now, you do need money, but it's just not your money. So you need money to buy houses, but not your money. That means that we're going to use other people's money. What these other people actually are. So the first other people will be people thinking, okay, other people could be the bank's money because the bank got money, yeah? Well, if the bank have the money, they have certain criteria that you need to meet before they will lend you the money. The bank typically will not lend you money to put down as deposit. But if you buy a house below market value, there is a large chunk of equity. There are lenders who would lend you based on the total market value versus the gap for the equity to fund the purchase one or the other way. Now, the typically way that for you to do is that if the house worth 200,000 and you are buying it with 100,000, then the differences for the gap will be 100,000. That's only just for the purpose of the exercise. It's easier for you to do. Typically, for buying a house worth £200,000, you put 25% deposit. That would be £50,000. Now, you can see, actually, if you buy this house, you'll be able to make 100K. And you only need to find £50,000 to pay for it. So if that's how it works, then you may either borrow this amount of money from the bank with your home secure, and then you buy the property, refinance the money back out and pay it back. So using the bank's money to finance both the deposit and the mortgage. So that deposit finance could be a secure loan, it could be a bridging loan, it could be a personal loan as a director's loan, it could be a business loan. Whatever loan that you're taking on, whatever equity you got, it all depends on your circumstances. And you must make sure that you have excellent credit rating for the bank to lend you that money, which you can use as deposit and then lend you the mortgage so that you have pretty much recorded 100% finance to buy the property. And that can be done multiple times. You know, you buy properties under your own name, under limited company. And typically, if you buy property under company name, then if your company have got equity, your company have got a trading record, which is pretty decent, you can then raise finance through the company, put down as deposit and purchase the property under the limited company, then refinance the money back out and buy your next house. That's how typically the bank's money work. What if you don't want to be, borrowing money from the bank because the interest could be quite decent, or you got bad credit rating? That's the typical one. If you got bad credit rating, the bank not bothered. They don't want to lend to you. You got CCJ in the past, or you got a horrible divorce, and then they reeled your credit rating deliberately not to pay the bill, so you end up with having a CCJ, whatever that circumstance is going to be. the bank don't lend you money. They will be giving you the mortgage maybe or not. This basically, the bank's door is closed. What can you buy without using your own money is that you then find somebody, we call it high net worth of property investors, could be angel investor, could be other type investor. They have got money sitting in the bank. They're looking for opportunity to generate more money from that money they have. We call it JV partners. That could be also a private, we call it private investor. Now, you may ask, how likely someone will give me the money to buy my house? Actually, if the deal works here, if you got 100K equity from a purchase, you almost guarantee that the money they lend to you could be back. Now, if you're buying a £200,000 house, you're making £100,000 profit. It's really high return. It's really, really high return. So it's talk about 50% return investment. Then really, if you're able to finance it out, it's almost low risk. If you've got a deal like this, you talk to pretty much anybody who's got 200K, they probably are quite happy to give you the money, providing that they know that it's safe and, you know, legally bounded. So how do you pitch the JV partner, private investor? First of all, you may want to understand how the deal itself works yourself, have a bit of education, understand how to analyze a deal. Second, you need to know how to negotiate the equity out. We call it below market value. Third, you need to be very good communicator, that you know how to pitch, you know where to find the high rich people with money, and you need to have the strategy as to discuss the terms, what they got security against the money, what you offer them as a benefit, what kind of amount of money return. Can you see it's not really, it might not really necessary for beginners, but if beginners have got the intention to learn this kind of strategy, you don't have to have previous experience to do it. I've taught a lot of investors to buy property without using their own money, using private investors' money. And they do deals worth £3.5 million. They raise £1 million from investors to invest in the property. There is people out there who lend you the money, providing you know how to structure the deal, you've got the paperwork in place, and you know the structure of how to secure their investment. So that can be done, and we have got it done multiple times in our community. Now, if you cannot find a private investor in time for the deal to be completed and the bank do not lend you money, what other option have you got? There is other options. Potentially, you can have creative finance, which could be a seller finance. We call this creative finance. With the creative finance, is basically helping the seller to solve their problem. Your intention, even though you could make money, your intention is basically solving their problem. Their property might be not easy to sell, or they will be in a rush to sell because they moved away from the location. Whatever reason that is, you then have been able to put together a package for the seller to finance you to buy the property by taking on creative finance, that you will be able to pay them on a monthly basis. Some people call that creative finance called lease option. So you have an option to buy, no obligation to buy. You pay them some money now, or you pay them no down payment. You take care of their mortgage. You rent out the property, or you can package the property deal with, we call it sandwich option, where you can sell this to another person who then pay for everything you need to pay for the seller to be going away. There is so many different strategies with the lease option itself or the creative finance itself. But just for the purpose for today, there were 3 types. There is more than 3 types, by the way. Maybe I go for, do you want to know a few more types? Yeah, so I'll give you a couple more then, yeah? So since you're a good listener. So first, the other people's money. The bank's money is the number 1. The second is the private investors. The third is sellers finance. The other one, it is something to do with other people's money with the bank, but it's not cash and cash. We call it credit. So you don't have a personal credit. Now, to use this, the fourth type, your credit rating got to be absolutely perfect, excellent. You will not be able to use this type unless you got a good credit rating. So you then basically use your own personal credit rating with the credit rating system to be able to use 0% finance, equivalent to 0% credit cards, 0% balance transfer cards, credit cards, and that kind of thing instead of a loan. So you use your credit card. Now, how likely can you buy a property with credit card finance? Very likely. I've done it plenty of times. I read books about it. A lot of other people done it plenty of times. If you know how to structure the deal, you can borrow money with a credit card, put on as a deposit, and then fund the rest of the purchase either with other people's money or the bank's money, whatever that it is. So it is completely possible. So I think the 4 different types, the first type, the second type, the third, and the fourth, yeah, are the main ones. I will be able to, if you're interested, find out a little bit more about how to use other people to buy property. I have got a training called How to Raise Finance for Property Investing, where I share 25 different ways that you can raise money to get started, to grow and to scale your property business using other people's money. If you are interested, get in touch. We will be able to, explain how this all work for you. And so you can start your property investing journey without having to worry about the lack of finance or having no money to get started. And then at least that way, from building the skilled up, you'll be able to have more different ways to raise finance, fix your credit rating, improve your credit score, and be able to buy properties without using their own money. And I've done that. I bought 18 houses the first 2 years without using my own money. And I help other people bought 6 houses in 6 months without using their own money. And I help other investors buy 5 to 10 houses a year without using their own money. So it's completely possible. You just need to know how to do it. And please get in touch if you get any more questions, anything else you wanted to know, and I'm more than happy to share with you. Thank you very much for watching. Until next time.